Your bank has a favorite type of customer. It's not the person with a fat savings account. It's the person running close to zero every month, timing paychecks against bills, hoping nothing clears early. That person is worth 12 times more in profit. I know because I used to work on the reports that proved it. This video is the math they don't put in the brochure, and the exact questions I'd ask if I were sitting across from your banker right now. Overdraft and NSF fees get sold like they're a little oops tax everybody pays once in a while. That's not how the math works. The CFPB found that 9% of accounts generate 79% of overdraft and NSF fees. And it gets tighter. 5% of accounts, the people getting hit 20 plus times a year, generate 63% of all of it. The median in that group is about $380 a year in fees, just for being slightly early on bills and slightly late on paychecks. And when you look at bank profit, the story flips. Oliver Wyman estimated a heavy overdrafter is worth about $720 a year in profit to a bank. A non-overdrafter, about $57. That's roughly a 12.5 times difference. Free checking isn't free. It's subsidized by the same small group paying penalties on repeat. And those 9% aren't a stereotype. They tend to have low balances, usually a few $100, lower credit scores in the 532 to 661 range, and they're overrepresented among renters, millennials and Gen X, and Black Americans relative to population share, per CFPB and Pew. The Fed found 16% of people earning under $25K paid overdraft fees, versus 6% of people earning $100K plus. Pew's estimate? Heavy overdrafters pay nearly a full week of household income a year in these fees. That's not bad luck. That's predictable cash flow volatility turned into revenue. Overdraft isn't a fee. It's ultra short-term credit priced like a financial weapon. The average overdraft fee right now is $26.77, bank rate 2025. Plenty of major banks still hit $35 like it's a normal number to charge for being broke on a Tuesday. The National Consumer Law Center did the math on what that really is. You go negative $26, you pay it back in 3 days, and they charge you $35. That's an effective APR north of 16,000%. Or you're $300 negative for 10 days and get a $35 fee, about 426% APR. Payday loans blush. And it stacks because it's per transaction. Some banks cap it, some don't. Then there's the multiplier, posting order. One bigger charge, say a $120 rent-related payment, clears first, and suddenly the 3 small purchases that would have cleared now each trigger a separate fee. Stay negative and you can get extended overdraft fees, $5, $10 a day, or every few days, turning one mistake into a week-long bleed. This isn't paranoid. Wells Fargo, TD, Bank of America, major penalties and settlements over overdraft and NSF practices. Pew found 68% of people would rather the card just decline. CFPB found only 22% expected their last overdraft. That surprise fee is what causes the next overdraft. I learned that at 26, when I thought I'd timed everything right, and woke up to 3 overdraft fees from one day because the bank posted transactions out of order. That was my welcome to the business model moment. Free checking is free, the same way a hotel is free if you don't touch the minibar. At the same bank, the richest customers pay nothing, and the poorest customers pay the most. Not because they're doing anything wrong, because the rules are written around what you can keep parked. Bank rates numbers. The average monthly fee on a regular non-interest checking account is about $5.47. Interest checking averages $15.65. That's up to about $180 a year just to exist inside the system. And yeah, they'll tell you it's avoidable. All you have to do is keep a minimum balance, often around $1,500, or hit a direct deposit requirement. Premium tiers want $10,000 to $25,000 sitting there like a security deposit for the privilege of not being charged. Tie this back to the overdraft math. Banks know a lot of accounts don't make them money. So monthly fees and overdraft fees end up subsidizing the free experience for everyone else. Industry folks talk about it pretty openly. For someone living close to zero, this is a negative interest rate on being broke. I'm curious, what does your bank charge you just to have an account? Drop it in the comments. The monthly fee, the minimum balance they want you to keep. I want to see what people are actually dealing with. Overdraft fees are loud. The quieter engine is the spread. Net interest margin. What the bank earns on your money versus what it pays you for it. Industry-wide, that margin was around 3.2% in late 2024 and about 3.4% by late 2025, highest since 2019. And you feel that in the dumbest place, savings accounts. Same $1,000, different bank. A lot of big banks still pay around 0.01%. That's 10 cents a year on $1,000. An online high-yield savings account paying 4% pays about $40. 400 times the interest for the exact same $1,000. Meanwhile, they'll happily charge you 24% on a credit card or 12% on a personal loan if your credit is solid. That gap is the business. So if you're thinking, I don't overdraw, my bank isn't making money off me, that's not how it works. They make money off idle cash and inaction. I checked my dad's savings rate on a Sunday call. Still 0.01%. That's how emergency funds quietly get smaller every year, even when you do everything right. In December 2024, the CFPB finalized a rule to cap overdraft fees at $5 for the big banks, the ones with over $10 billion in assets. It wasn't a speech, it was an actual rule with teeth. Then it got killed before it ever mattered. The Senate voted to repeal it in March 2025, 54-48. It was signed into law in May 2025. And here's the part that doesn't get said out loud. Now the CFPB can't issue a substantially similar rule again unless Congress lets them. So that door is closed. The CFPB estimated that cap would have saved consumers about $5 billion a year. Gone. So the rule that would have saved regular people billions got repealed, which means your bank account settings are your regulation now. Yes, some banks made changes on their own. Capital One, Ally, Citi, no overdraft fees. Bank of America dropped from 35 to 10. Good. But the legal ability to charge you $35 for being short is still fully intact. Waiting for the market or regulators isn't a plan. You have to move yourself. Tomorrow morning, do a 15-minute audit on your bank like you're auditing a contractor. If they start hand-waving, stop them and ask for the fee schedule or account disclosure. If it's hard to find, that's the answer. 6 questions. 1. What's the overdraft fee and what's the daily cap? 2. Do you charge extended or sustained overdraft fees and when do they start? 3. Do you ever post transactions out of order, high to low, or anything non-chronological? 4. What are your NSF fees and do you charge again if an item gets represented? 5. Can I opt out of overdraft coverage on debit card transactions so it declines instead of charging me? That opt-out exists for a lot of people, and banks don't exactly put it on a billboard. 6. What APY do you pay on checking and savings, the actual number? Then the exit criteria. No monthly fee or a waiver you can hit without keeping $1,500 hostage. No overdraft fees, or at least a real cushion, a real cap, and a clear grace period. No NSF fees, especially no double dipping on representment. Savings APY that's in the same universe as a high-yield account. And ATM access so you're not paying fees just to avoid fees. When Dana and I switched a few years back, she asked these exact questions. The branch rep didn't know half the answers. That tells you how normal it is to pay for rules nobody can explain. If your bank fails 2 or more of those standards, the math says you leave. Loyalty isn't a financial plan. If this is the first time someone's shown you the math, subscribe. I do this regularly, and hit like if it's been useful.